that when it comes to your investments into equity mutual funds in particular, of course, the tendency is to go on to maybe a few websites to take a look at the star rating or the past performance of a particular scheme. But if you're a watcher of this program, then you know for sure that that past return is almost never a guarantee of future performance. And so how do you judge the performance of a scheme relative to others in the space? And how do you know if it's appropriate for you? There are actually a few metrics that you can look at that will tell you about the relative health of the mutual fund scheme that you might be considering investing in. To talk about some of these metrics, I'm joined today by Varun Fatehpuria, who is the founder and chief executive officer of Daulat Wealth Management. Varun, thanks so much for taking the time. And the reason I called you and told you that I wanted to do this subject is because I was thinking about a metric called portfolio turnover, which is essentially how much churn a portfolio sees. That's one of the metrics that you've been looking at, right? So what are the 4 or 5 metrics we'll talk about, and then we'll dive into each one of these in detail?
Yes, hi Alex. I think as you correctly pointed out, obviously we need to look beyond just the point-to-point returns in determining which fund actually fits well in our portfolio. And one of the portfolio or the ratios that we look often as a starting point perhaps is the portfolio turnover ratio, which measures how actively the fund manager is buying and selling securities within a portfolio over a given period of time, which typically tends to be a year. Right? So just to make it simple for the audience to understand, let's say in a period, the fund manager buys securities worth 50 crores and sells securities worth 50 crores. Here we'll take the lower of both the amounts and divide it by the average assets under management over that period. So once we do the calculation, let's say if the ratio turns to be over 100, what it is effectively telling us is over that period of time, effectively the fund manager has flipped the entire portfolio, maybe in a quarter or a half yearly or a year. But let's say if the portfolio turnover ratio is less than 100, that means only to that percentage is where the portfolio is actually being churned. And the reason why it is important, Alex, is because it has implications. Let's say we are comparing 2 schemes, a scheme which has a higher portfolio turnover ratio compared to scheme B would automatically have implications because higher the churn in the portfolio, there are cost implications with respect to every time you buy or sell a security, you need to pay the security transaction tax. There is a brokerage amount, GST, stamp duty. All of that impacts a investor's return in the form of a higher TER, which is charged to the NAV of the fund.
Okay,
so we have pulled in some data.
Yeah, no, before we get to that, I want to ensure that everybody is on the same page. And at the cost of boring a couple of people who are familiar with this, when you say TER, you're talking about the total expense ratio, which is essentially the cost that you pay to a mutual fund to manage your money. It is described as a percentage of the NAV, which is the net asset value, which is simply the per unit cost of the mutual fund that you're investing in, right? So hopefully that has cleared things up. Now the example that you're talking about, Varun.
Yes, so we have taken 2 schemes in the midcap category. One of it is the Motilal Oswal Midcap Fund, which has a portfolio turnover ratio of 1.3. And if we compare that to of HDFC Midcap Fund, the PTR of that is only 0.21, right? So let's see what that means. PTR, as I pointed out, of 1.31 effectively means that 130% of the AUM has actually been churned over a period of 1 year, compared to, let's say, that of only HDFC Midcap Fund of 0.2, which means only 20% of the portfolio has been churned. So we know that Motilal Oswal Midcap Fund as a fund management style has a slightly higher churn in the portfolio, and that is reflected in the PTR. And that is also, as we pointed out, plays into the overall cost that the investor has to pay in the form of the total expense ratio.
Is that necessarily a bad thing, Varun? Because if the stated objective of the fund is to take, for example, certain quant indicators that certain fund managers like to do, or to change very quickly based on the signs that they're seeing, this is par for the course. But if there is a significant deviation, there's a problem. Is that the right interpretation?
Yeah, that's right. I think you need to understand what you're getting into. Let's say something like a diversified equity fund, when the mandate is to let's say, stick with holdings for a longer period of time. So let me explain that with another example. Let's say if you're holding a value fund, that by definition needs to have stocks in their portfolios where they will continue to hold over a period of time. So if you're seeing a fund which is having an abnormally high PTR in the value category, that could be a sign of concern. But let's say in this matter, they have been very vocal that they are going to have high churn. So to that extent, I don't really see so much of a problem from that point of view.
Okay, and just one more point, which is that the cost involved, as you've pointed out, because of the high turnover ratio, because ultimately this is a cost that you will bear as an investor, right? Because it's going to eat into your returns to that extent. Every time you sell a stock as a fund manager, there is a booking of a certain amount of a brokerage. There is going to be securities transaction tax, as well as certain other taxes, right? How much of a bearing do you think will that have on the final return, or is it negligible?
No, it definitely does have. See, Alex, we have to realize, I think, one thing which the mutual fund does not pay is the capital gains due to the Section 1023B of the Income Tax Act, where the income tax or the capital gains is finally just borne by the investor at the time of the redemption. So the tax incidence from a capital gain perspective is not applied. But yes, as you pointed out, there are cost implications with respect to brokerage and the stamp duty and the security transaction tax. I think the SEBI has just come out with a circular just a couple of weeks back inviting consultation papers for having an input on how much of the cap there could be on these costs. But yes, I think these costs does have an impact on the returns. I don't think so you can completely discount it.
Okay, yeah, absolutely. And the consultation paper that you're referring to, of course, is the consultation paper on total expense ratio, which we've covered on this program. I'd invite you to go onto YouTube and take a look at how, if this comes into play, how much your cost will reduce as a mutual fund investor. But let's talk about the second topic that we've picked within these metrics, which is the upside and the downside capture ratio. My understanding of this, Varun, is that this helps you understand relative to the benchmark of a particular scheme. So, for example, in a large cap actively managed fund, the benchmark is the Nifty 50 or the BSE 100, as the case may be. You would talk about how much an actively managed fund falls when the market as a whole is falling, and how much it rises when the market as a whole is rising, right?
Yes, so both the upside and the downside capture ratio, Alex, measures the performance of the fund relative to the benchmark and what portion of that return is the fund able to actively capture. So let's say in a market where we have been over the last 12 to 15 months, assuming the index had fallen by about 10%, if a fund had fallen by, let's say, more than the index, let's say 11% for that matter, the fund would have had a downside capture ratio of 110. But on the contrary, if the fund would have fallen less than the benchmark, then the downside capture ratio would have been lower than 100. So what effectively it is telling the investor is, let's say in a rising market, if the fund has a higher upside capture ratio compared to the benchmark, which is more than 100, it is able to provide you higher returns than the benchmark. But on the flip side, in a scenario where we are in a bear market, and if the fund actually falls significantly lesser than the benchmark, in that way it is actually protecting your capital. So even in this scenario, we have taken a look at a couple of situations. Let's say in the flexi cap category, the star performer in the downside capture ratio is the Parag Parikh flexi cap fund, having a capture ratio of only 28. What it is telling you, if the benchmark has fallen by 10%, this fund has fallen effectively only by 2.8%. If we compare that to an HDFC Flexi, that has a downside capture of 57. So if the benchmark has fallen by 10%, this has fallen by about 5.7%. On the flip side, Parag Parikh has an upside of 85 compared to HDFC 101. So as we see in a rising market, HDFC is actually able to capture more of what the benchmark has given compared to Parag Parikh.
Interesting. As an advisor, when you are selecting schemes for people and you view this, of course, you're viewing this in addition to a lot of other factors. But would you prefer a scheme with lower downside capture ratio and not necessarily the best in class upside capture ratio? Or would you prefer somebody that has a lower than 100 downside capture ratio, but a phenomenal upside capture ratio?
I would say usually what we have seen with investors is during a bear market, they would actually, like to lessen the impact of how much their portfolio actually falls. So no matter what someone says, I think that drawdown in the portfolio is something that they are not really able to handle. So definitely the preference is towards schemes which have a lower downside capture ratio, because what it does is effectively helps you protect that capital. So the recovery is slightly faster when the market cycle turns.
Okay, two more to go through, and they're actually related to each other, which is why we've kept them to the end. One is standard deviation, and we've spoken about this often on the program, but let's run through this as well. Don't worry. Of course, it's a mathematical formula, and you don't necessarily have to go into the details of how this is calculated. Varun is going to explain why this reading is important and how you should read it. Varun?
So put it simply, I think without getting into the maths of it, I think standard deviation measures the volatility of the fund, and that in effect measures how risky of the fund. So let's say whenever we are talking about the riskiness of the fund, we are talking about the standard deviation, which is a measure of volatility. So let me give you an example. Let's say if you're looking at the entire spectrum of today diversified equity mutual funds, starting from large cap, mid cap, and small cap. Small cap tends to be on the other end of the spectrum where the volatility is higher, the standard deviation is higher, and therefore the risk is also higher. So that is what we are telling Alex when we're talking about standard deviation, because the range of the investment outcome relative to the median return, the dispersion is so much in small cap is that there tends to be a larger a variety of returns that an investor could have over a period of time. So large cap in essence.
Essentially,
Yes.
it's variance of return, right? Over a period of time, Varun, and here you've given two examples. ICICI Prudential Large Cap has a standard deviation of 11.63%, whereas Quant Large Cap has a standard deviation of 15.42%. So you would look at the compounded growth rate over a period of time, or return over a period of time, and you would say a higher standard deviation would mean that it could actually go upwards to the extent of 15 percentage points or downwards to the extent of 15 percentage points. So for example, if it's 10% or 12% compounded growth rate over a period of 5 years, and if the standard deviation is 15%, then at any given point of time, you could actually have had negative return in that scheme, correct?
Yes, that's right. And effectively, it is telling you the range of outcomes. But what we also like to tell investors is, Alex, that in and by itself is not necessarily a bad thing, which brings us to the fourth ratio that we often talk about, which is the Sharpe ratio. So you need to evaluate managers relative to how they have performed on a risk-adjusted basis. So continuing with that example, ICICI Pru Large Cap has a standard deviation of 11.6 and Quant has a standard deviation of 15.4. But let's say we need to see how much the manager has generated per unit of risk that they have assumed in the fund. If we simply divide the portfolio's excess return, which is the portfolio return, minus, let's say, a 1-year treasury bill return of 5.5%, divide that by the standard deviation, that is going to produce something called as the Sharpe ratio. So in this case, despite Quant taking a significantly higher amount of risk, that has not translated into better risk-adjusted performance, given the Sharpe ratio is only 0.2 compared to ICICI Pru's Sharpe ratio of 0.7.
Okay, seen in isolation, just to drive home this point, unfortunately, we're running out of time. Maybe we'll have to do a completely different show on this. But a lower standard deviation coupled with a higher Sharpe ratio is a good thing, correct?
That's right.
So broadly speaking, if you look at two schemes that you like in a category, a lower standard deviation means that the variance of returns over a period of time is lower. And in the second instance where you're talking about Sharpe ratio, Varun has explained that it looks at a risk-free return and it looks at your risk-adjusted return in that particular scheme. So bear that in mind when you look at these two things, but look at these two things in combination with the other factors that we've talked about, and also the rolling returns over a period of time. Varun, I think this has been a fantastic conversation. Thank you so much for taking the time.
Thank you, Alex.
All right, viewer, we've given you a sense of how to look at your own mutual fund portfolio. Take a look at these metrics. You can find them in quite a few areas on the net. Let us know what you think about your portfolio and whether you would like to learn about more metrics to use to track the health of your portfolio. In the meanwhile, stay tuned. This is NDTV Profit.